Next, demerits of equity shares. Here also we need to discuss in two ways. One is company point of view demerits and second investor point of view demerits. So let us discuss about company point of view demerits. First one, cost of equity. Cost of equity is generally higher. The rate of return required by equity shareholder is generally higher than the rate of return required by other investors. Second, permanent burden. Generally, equity shares are permanent for the company. So, it creates permanent burden for the company during the time of payment of dividend. Third, flotation cost, which means cost of issuing equity shares, which is higher than cost of issuing other type of securities. For example, underwriting commission, brokerage, and other expenses higher for equity shares. 4. Interference in management. This is one of the disadvantages of a company. Why? Because equity shareholders have voting rights. Hence, there may be interference in existing pattern of management. Fifth, speculation. Since joint stock company activities are functioning in public domain, so there are the higher chances of speculation because it is traded in stock market. Sixth, dividend is not tax deductible. Equity share dividend is not tax deductible payment. So obviously it is a disadvantage for company. Seventh, dilution of control. When company rise sale of equity shares to outsiders, it affects dilution of control of existing shareholders. Next, investor point of view demerits. First one, uncertain return. No fixed rate of dividend is to be paid to equity shareholders. Only directors have the authority to decide whether to declare dividend or not. That's why this is the main disadvantage of demerit investor point of view. Second, residual claim on income as well as assets. Equity shareholders have lost priority on income as well as assets after satisfying claim of others. Third, low market value. When company declares low dividend or postpone the dividend, finally shareholders or investors suffer a capital loss. Fourth, risk investment. Equity prices tend to fluctuate widely and frequently. Finally, making investment is so risky. Fifth, higher speculation. During boom phase of stock market, equity shares may encourage too much speculation so that it may mislead investors by higher speculation. Sixth, dilution of control. The issue of new equity shares may dilute ownership and control of existing shareholders while a preemptive right to retain their proportionate ownership, so they may not have funds to invest additional shares.